How is everyone? So we're starting just a few minutes early, and I wanted to basically, hi everyone. I'm seeing the chat messages here, so feel free just to kind of say hi or any messages throughout what I'm saying. So the presentation today, or the discussion, as I hope it will be, is on Black Swan Volatility and the impact on oil, Japanese yen, and key markets. So I'll start off just by hopefully you can see. Can everyone see the screen right now on shot? It's basically live FX prices on most of the major currencies. Yeah. I like to begin with real-time prices. I'm sure each of you are looking at the markets and maybe have a few positions on. So I want to make sure that you know where the market is now. And you can see here we've got dollar, euro, Japan, sterling, Swiss franc, and then some of the commodity-driven currencies versus various pairs. Now I'm going to switch from this screen onto the chart screen. Just 1 second. Yeah, so this is the screen I wanted to show. So these are just the intraday price charts on some of the key markets out there. You can see just now euro dollar. I'll just maximize it for you. Just basically turning off key resistance, and now the high of the intervention. Bank of Japan, quite that will be during our conversation. And then various other markets, sterling pushing down to the lows, oil above $100, gold, in my opinion, kind of going sideways at the moment, but still beneath the record highs, silver, and then a few of the equity markets down below. So that's just a general kind of overview. I've just given you a few FX numbers and just a few macro charts to keep in mind. And now we'll go straight into kind of a few slides which I've prepared for the opening discussion. Just a moment. So I'm just going to get the presentation up now. And I'm just basically going to walk through just a few slides, and then hopefully maybe take some questions throughout. So this is just a great starting point for any discussion about the financial markets, and we basically we're looking at a statistical chart of probability, and this of course is one of the things that is critical to any market analysis, being able to work out where the markets will move to. Now for many years the belief has been that markets move in a random way, and that most market moves are unpredictable. So that's basically the chart that you're looking at now. If I just show you with the mouse, the black line in the middle is the mean, the average price movement throughout any market or any probability generally. And to either side is the standard deviation. Now the key message behind this diagram is that you have small tails. You see with the highlight in yellow on the left and the right, here and here, basically highlights the fact that markets don't undergo high probability events that much. There isn't that much high probability, any big moves in the market. Now, if you just think about that, just ask yourself the question, how many times have you seen a very volatile move in the market in the last few weeks or the last few months? Anyone want to give me a few examples? Feel free to just say through the chat. Any key markets, of course, you've got Japanese yen, oil, and then various other markets. Now, this is a question I want to pose to everyone that's in the group, if possible. If we could just maybe encourage a little bit of feedback. This is a question I like to ask people 2-3 times per month. Absolutely, even faster than that sometimes. So this is a chart basically showing you measures of volatility across various markets. So there are 4 markets here. Each market has a different characteristic of volatility. So high volatility, low volatility. My question to you is, one of these diagrams of volatility is fake. It's not real. It's produced by a computer randomly. And I'd like to just ask people in this room, which one do you think is the fake market? How many people say 1, 2, 3, or 4? Oh, we have a consensus view here. Okay, can anyone tell? No idea. Honesty is important. So my next question is, okay, so most people are saying the second diagram, which is, of course, this one. Some people are saying the first one. Some people are saying they're not sure, which is understandable. My question to you, my next one is, why do most people think it's the second one? So if anyone could just basically just type in the chat, why do you think it's the second diagram? Why is that? It's too smooth, too even? Yeah. And that's the point here. You don't really need to have a background in financial markets or even statistics to spot the difference. You just need to have an eye for detail. And what we have here, as one of the people in the chat just said, there are no spikes. It's even. It's a very constant move in the market. So you still get deviations. You still get moves up and down on this chart, but it's fairly minimal. Now, of course, most of us know that that's unrealistic. In the market, we get much larger deviations and deviations that happen a lot more frequent. So you can see here on this volatility measure, you have a high volatility move, low volatility. On the lower chart 4, you get quite a lot of spikes, and chart 3. But chart 2, this one here, is quite conservative. So the message here is that all the computer models in the world help us understand things in as much as a realistic way as possible, but the market reality is volatility exists. And it's the very thing that makes the market what it is. It's the very thing that creates trading opportunities for us. That's the message behind this slide. Volatility does exist. It's something that we look at, and some of you are saying it's predictable. Yes, volatility is predictable to an extent, but I would also say that it's unpredictable to an extent, and hence the title of today's discussion, Black Swan Volatility. These are things that surprise us, things that is very hard to prepare. So yes, someone just said just now that the second chart would fit in with the random walk theory. So yes, that's an example of random walk theory picture of volatility. Now the next slide is actually what's very relevant to the markets that we know. And here it's a probability distribution, but it's the one that is much more realistic to what we know exists in the market. And here you just see basically that you still get random moves around the mean, this center line, deviations to the left, deviations to the right, but most importantly, you get massive deviations. So think of several standard deviations, big volatility in the market, either positive or negative. Now, these are the moves that we see every single day or every single month or every few years. This is what makes oil double in value. This is what makes the stock market crash, and this is what creates intraday volatility. Yeah, and basically the buzzword for this is fat tails. The long ends of this diagram, or the big deviation, are what we refer to as fat tails. Now, fat tails is just an allusion to big volatility in the market. Now, I just want to quickly kind of highlight the pictures which I put on this slide, which are swans. Does everyone know the general story about black swans? Why do we call big volatile moves in the market black swans? If you're not sure, feel free to take a guess. So we're getting a few no's here. I'll quickly just give you the story. Basically, yeah, they are very rare. Black swans are very rare. What is very usual is white swans. And for some of you who might maybe go by the lakes that we have here in Switzerland or various other places that you live nearby, white swans are much more regular type of swans that you will see. About 200 years ago, I think a person saw a black swan, and it was a big discovery. And so that terminology, that metaphor was used for rare events, black swan events. So if someone's saying that they have lots of black swans near where they live, please send me a postcard. But yeah, I mean that's a good point. Nowadays we see many metaphorical black swans in the market, and this kind of brings us fast forward to why we're having this discussion right now in terms of what's happened over the last few weeks and certainly the last few months. Now, I want to make sure that I bring this back to realistic market examples, and that's why I'm showing you this chart here. These are different characteristics in the market, and the one variable in each of these environments is volatility. There are markets with high volatility, and there are markets with low volatility. Volatility is constantly, dynamically integrated within the market. And so we have 4 charts here, but each of them looking different. The first chart is a strong uptrend, which most people like to see. And then the second one is also an uptrend. Now my question to each of you is, how many of you prefer chart 1? How many of you prefer chart 2? They're both uptrends. Which one do you prefer, chart 1 or chart 2? I'll give a few minutes. Out of the top 2 charts, chart 1 and chart 2, which ones do you like? Some people said chart 4. That's a little surprising. Chart 2. Anyone that likes chart 1? No preference? Okay. Basically, yeah, chart 1 is a very nice, predictable uptrend. And the very nice thing about it is it has low volatility. And that basically means you can buy and hold and not really worry about big drawdowns, big corrections in the market. So you can get your trade ideas wrong several times and still make money. Chart 2 is exactly the opposite. It's still moving up. So, if you buy and hold, you'll still make money. The problem is you get big volatile corrections, drawdowns along the way. So you see this drawdown here, this drawdown here, and this one. This is what I refer to as heart attacks in the market. So if you can think of yourself as holding a market position, you're buying the market, but along the way you get these massive corrections. So some people might say, oh, I think Eurodollar is going to move to new highs. I think oil is going to move to new highs. But of course, the one thing that sets apart one person that makes money and one person that doesn't make money is how volatile the market is and how they're able to manage their risk. So that's the message behind this diagram here. Volatility does matter. It differs from market to market. You have low volatility and high volatility. And of course, low volatility trending markets can be quite good to trade. The markets that we're in right now is more like chart 2 and chart 4. Chart 2 is a trending market with high volatility. Chart 4 is a sideways market with high volatility. And some interesting ideas being shared here. That building a position, you can build up a position and you can maybe switch into different environments. Sometimes markets switch characteristics, so they can be volatile and then move into low volatility. But for the purposes of this discussion, I'm mainly just talking about increase and decrease of volatility. Any questions so far? Because now I'm going to jump into discussions on oil and Japanese yen before we open it up to key markets. Any questions? Okay, I'll move on quickly then. So we'll start with oil. And usually I like to start with a chart, but because I'm not an economic or political or fundamental expert, but I do gauge sentiment in the market. And of course, as a technical analyst, we try and see how sentiment will, but suffice to say, it's basically increasing the price of oil, and most would believe will continue to do so as the contagion spills over from country to country in the revolutionary moves that are taking place. Now, in terms of price movements, I want to we're going to talk about, and basically the big point is this very strong uptrend that we've seen since the post 2008 crash lows here around the $40 level. We've risen quite a lot, more than 200% appreciation into the $100 psychological level. And of course, $100 psychological level is a very important level in the market. And my personal view is that we're going to hold above that level for some time. We may deviate around that level, but we will, in the medium to long term, hold above that level. The targets, which I've cited in various articles, which you can find on FX Street, is $120 on crude oil, West Texas, which is a key resistance zone. There are multiple targets centering around $120. The next target is $130, and that's the kind of big call that I'm making for oil over the medium term to long term. Any questions on this so far? So I've given my initial big price targets on oil. Does anyone have any questions on oil before I move on? Feel free to ask questions if you'd like to. Okay, I'll move on then. So there's someone asking now, in the mix of fundamentals and news events, we have U.S. bonds, job numbers, industrial production. What should we be looking for since you can't find what you're not looking for? And once we know, so the first question is what should we be looking for in all the noise of information that's out there? Second question is, once we know what we should be looking for, how do we organize it by order priority to form a buy? Okay. So let me answer that question. So the first thing is, how do we prioritize all the news, all the fundamentals, all the economic numbers that are coming out every single day? Now, to answer that question, I'd say probably simplicity is the best thing. Part of the problem that we have right now is that there is too much information, and that's creating a lot of noise and a lot of mistakes in the market. It's also creating a lot of volatility in the market. And right now, my perspective, my observation would be that the market is very emotional. And I know I sometimes talk about the market as a person, but that's one good way of thinking of the market. Think of it as a best friend or maybe a partner. I don't want to get too personal, but just think of someone you know well. And the market is proving quite emotional now. It's responding to a lot of noise and a lot of speculation out there. So I would say focus on just the bare essentials, the technical analysis outlay I'd recommend. So focus on the trends in the market, focus on the key levels, and maybe some of the indicators you're looking at. News-wise and economic-wise, I would probably try and filter that out. That would be my first answer to the first question. Second question, in terms of, just one second, I'm just going to answer the second question. Okay, I'll move on to the next question. Looking at this chart, because you're all looking at the screen, I just want to make sure that I've made this chart relevant. The type of analysis I'm using here, first of all, I'm using Elliott wave analysis, which is just a way of understanding the market structure, the market cycle in the market. So this is an area that I focus on quite a lot in terms of market cycles and Elliott wave analysis. The second thing is I will look at various classical technical analysis overlays, one of which is, for example, just basic trend analysis. And here we have a trend channel with just various projections. You can use Fibonacci projections, or you can use just standard round number projection. And so here, this is just basically saying the channel from June 2009, which we broke below and then moved back up again. This is 150%, 200%, 250, and then 300. So I'm using this as a rough guideline, but I also have Fibonacci retracements from the 2008 financial crisis highs, just basically also coming in at the 120 level. You can see there the 76% Fibonacci level also coming in at 120. Okay, I'm going to move on to the next slide. In terms of cycles, this is probably the main reason why I'm bullish on oil from a technical perspective, from a long-term cycle perspective. My apologies to some of you that focus more on short-term intraday price action. This is a very long-term. We're looking at oil going back to 1970, so it's quite some history that we're looking at. But the key thing to keep in mind here is how long-term cycles exist. Take a moment to look at the chart and just absorb the information. Long-term cycles exist in the financial markets and definitely in the commodity market. And what we see here is that long-term cycles alternate. So you get bullish, positive cycles, bearish, negative cycles, and then again bullish cycles. And if I just go through here, the latest bullish cycle was from 1999 until now. So that's 12 years and counting. But what most people forget is that previous to that, we had a bear cycle between 1980 and 1999. So that was 19 years of oil prices going down. Can everyone see this chart? I just want to double check. It's a very important chart. Can everyone see this chart? Great. So between 1980 and 1999, we had a big bear cycle. And then finally, between 1970 and 1980, that was the bull cycle before that. What's interesting to keep in mind is the yellow highlights are economic recessions. And so that's an important point that I want to make, that of course high oil prices do encourage economic recessions. And here you can see recessions in 1973, 75, 1980, 1990, 2001, and then 2007, 2009. TMT crash is the technology, media, telecommunication crash. It's basically the dot-com, the technology crash that we had in 1999. So the first thing to keep in mind is long-term cycles. They alternate, positive, negative, positive, and they last for several years. Second thing to keep in mind is that, of course, these cycles also create economic recessions. High oil prices and high commodity prices can trigger economic recessions. And the third thing to keep in mind is, of course, the military wars which took place every time we had big spikes in oil. And, of course, we have the Middle East and North Africa revolution, which is taking place as we speak, taking place right here as oil prices go up. But that's also, of course, related to super increases in food inflation and how that's affecting various lower and middle classes. Then we have the Persian Gulf War, Iraq, Kuwait during the 91 period, Iranian Revolution, and Yom Kippur War and the oil embargo. And I just want to answer some of the questions I'm seeing here. So one person's asking, the 2008-2010 crisis didn't end your bullish cycle. That's a good question. Short answer from my side is it hasn't. It did create a big shock during that cycle, but I'm basically avoiding what happened during that time and focusing on what's happened since. One of the reasons why I haven't ignored this big shock, which was more than a 70% crash in oil prices, is because oil prices has retraced most of that move, and in my opinion, it's going to move back up to the highs. So the target I was talking about was $120, $130 on oil, but of course we could also see even higher prices than that. So short answer, I'm not ignoring. I am ignoring this, and I'm maintaining a long-term bull cycle. That's a good question. So someone's asking, what about the relationship between the dollar, the US dollar, and how does that affect? Yeah, I mean, most commodities are priced in dollar terms, so that tends to create a negative or an inverse relationship. So higher commodity prices tend to produce lower dollar prices. Now, if I had some extra time, I'd be able to show you how that looks on a chart. I can do that in future seminars, future discussions. But yeah, traditionally, high commodity prices usually encourages lower dollar currency and vice versa. So that's, I mean, the key message behind that is when you look at this chart, we're just looking at oil, but you need to keep in mind, how cycles affect many other markets through intermarket relationships, correlations, through economic impact, inflation, and economic growth, and all the other factors that come in here. Now, that's just long-term cycles that I've kept on the screen for a while, so I hope you've taken enough information from that. The next slide I want to talk about is keep in mind what happens during big crisis events in the market. Now, this is a snapshot of what happened to oil prices during the Persian Gulf War between August 1990 and February 1991. Can everyone see that? Persian Gulf War between August 1990 and February 1991. Great. And that just basically shows that markets literally stormed higher about 164%. Now, one of the important disclaimers I want to say is that, I'm not saying that is going to happen, and history is not always the best reflection of today and future price moves, but it is an indication of what might happen. And in all we do in the market, and in all my years of experience, in several years, 12, 13 years I've been in the market, all I've ever done and all I know people have done is basically work out the probabilities. And the probabilities are what we deal in, not certainties, probabilities. And so this gives an interesting probability of what happened during a crisis not so long ago in the 1990s. Now, I'm showing this to you also because this is partly built into the target I gave you at $130. So when I was showing you this slide, so $130 as part of my target equates to 1/3 of oil's price gain during the Persian Gulf War. So I'm being very conservative here. I'm just basically looking back in history and seeing what happened to oil prices during crisis moments, and just basically picking 1/3 of that. And then that's something we do a lot in the market. We pick out kind of strategic numbers, 1/3, half, or 2/3. And here I'm just saying 1/3 of what happened during a military crisis event, which was actually one or two countries, not the whole of the Middle East. That 1/3 fits in with my $130 estimate for where oil prices can go from now. Any questions on this so far? I'm jumping around from various points, but I hope it's valuable information, and I hope it's of interest to everyone. Any questions? Okay, so someone said all good. That's positive. Okay, so just to keep in time, moving away from historical events and moving away from estimations, I like to. Okay, I'll come back to this question about how things have improved 20 years on. Saudi Arabia can increase in introduction. Let me answer this question first. I'll go back to our map of the Middle East just to center our attention. Again, I'll start by saying I'm not an expert. I'm not a political expert, an economic expert, but keep in mind one thing. There are also unknown events that can take place. The one thing I think is a fair statement is that there is nothing predictable about context. What I mean by that is it's very hard to predict the unpredictable. And so as a technical analyst or as traders looking at the FX market, when you're looking at FX Street or various brokers that you're trading through, keep in mind that one of my key lessons from this discussion is to be prepared for the unexpected. And part of the problem from all the news that's coming out right now is that a lot of the news and the sound bites which are coming from television is just basically trying to offer us some comfort so that we can feel that everything's okay. And everything is okay, but at the same time, you need to be able to adapt to big deviations, big volatility moves in the market. So that's what I would do. I would temper your views on supply replacements from Saudi Arabia or things getting better or how things are much better 20 years now from how they used to be. Keep in mind that things can change, positive or negative. And as a trader, the best ones are always able to adapt to change. So that's all I'm saying. Think of volatility changing, positive or negative. This could be down to the Middle East. It could be down to any other market action. Japan, for example. Everyone's attention was focused on Middle East. We're focusing right now on the Middle East, talking about oil supplies and various other things. But who could have predicted the tragic event which took place in Japan? And so we're in an age of fat tail events. As a famous fixed income portfolio manager once said, we're in a new normal. So whatever you knew before has changed. So someone's saying true, but whoever wins any oil war in the end will want to produce and sell the oil, thus any impact will be short-lived. Would you agree? I'm going to try my best not to get involved in fundamental discussions. To an extent, yes, I agree. A lot of my strong positive view on oil and commodity prices is built in within my cycle analysis. So one of the key things that I specialize in is cycle analysis from a long-term perspective. From a fundamental perspective, I'll probably just hold off from that question. Maybe I can take up that question afterwards. But you're right. Oil dynamics do matter. I just want to move on, just for the purpose of time, onto other charts, so we can save some time for Japanese yen. Now, the last chart I want to focus on in terms of oil. So here we're looking. Can everyone see this oil chart showing volatility on oil? Now, remember I said that volatility exists in every market. It increases, it decreases, and here we see the characteristics of oil within the oil market. And interestingly, we see how volatility can, and in my opinion will, deviate much more than it already has. So here we have, if you look at the deviations, this is the mean, the red line, the kind of average measure of volatility over the last 10 years. But on the plus side, this is a 1 standard deviation. And higher than that, the green line is 2 standard deviations. These are really big moves on the oil market. On the lower side, this is minus 1 standard deviation. This is whenever oil prices fall. Up here is when oil prices rise. Now, the message behind this is that volatility can get much higher if we look at historical volatility. 2007, 2005, 2003, and 2001, these are all peaks in volatility which moved up to 1 and 2 standard deviations. This is actually what happened. Now, if each of you wants to maybe do some interesting homework, maybe you want to look into each of those years and find out what happened. It's not always been the Middle East. It could be other related reasons. But the message here is that we do have regular spikes in oil volatility. Not only that, but my belief is that these spikes in volatility are cyclical. Again, I'm bringing back the focus to cycles. And here we just see that almost every 2 or so years, there's a big spike in oil volatility. Everyone okay with what I'm saying so far? So what I'm saying is that volatility exists in the oil market. We all know that. But most importantly, when we look at it historically, we can see exactly how high oil volatility can spike, can increase, and how regular. That regularity, in my opinion, is cyclical. It's rhythmic. It happens every 2 or so years. And as you can see here, this arrow here, this is the time that we are due further volatility. Now, this is a chart that I did a while ago, so it's not currently up to date. But suffice to say, oil volatility is slightly higher now. And my opinion is that we can see volatility back up to 1 standard deviation at least, which would mean oil moving up into $120, maybe higher. So that's a good question, Mike. Bollinger Bands are great for showing deviations, and sometimes I use Bollinger Bands on not only on price charts, not only on markets, but I also use Bollinger Bands on volatility. So I will regularly use Bollinger Bands. For those of you that use Bollinger Bands is just basically an indicator which measures volatility. It measures standard deviations, up to 2 standard deviations of any move in the market. So the short answer is, yes, I do use Bollinger Bands, but here, for those of you that are interested, I'm just using regression bands. So this is just basically a tool that I use on my Bloomberg chart platform, which measures regression or standard deviation in the market. So the message behind this, oil's historic volatility signature, how high can oil volatility get, how regular it is, and it does show that we still have some upside to go in terms of statistical 1-month volatility. Okay, so that's it for oil. We spent some time looking at oil. We have about 10 minutes that I can share with you or that you may have questions on. So I will keep 10 minutes at the end of this for any Q&A, any questions and answers on other markets, euro dollar, Japanese yen we're going to talk about now, any commodity markets, any equity markets. I'm happy to talk about all markets. Okay, so now we'll get started on dollar yen. Is everyone okay so far for me to start on dollar yen? Yeah? Okay, I'll start now. And the headline here is yen deserves at least 10 minutes. I agree. Maybe more. So dollar yen is probably the most topical thing right now, and it's very close to my heart. I've been staying up late at night looking at dollar yen, and my colleague here who's sitting next to me, Jonathan, who works with us in the marketing team, helps out with our reports as well. Now, sterling dollar, I can look at. I don't cover sterling dollar. My colleague Bijoy Carr does, but I can maybe say a word or two. Okay, so the message here is that dollar yen is at a critical point. More than that, the message that I want to communicate here is that, in my opinion, dollar yen is undergoing a major turning point. What I mean by that is Japanese yen depreciation, dollar appreciation. So I believe that the US dollar is going to gain in value and the Japanese yen is going to lose substantial value over the coming months. So I want to make that clear from the very start. I'm looking for a bullish medium-term reversal, long-term reversal on the dollar yen, which is positive for the dollar, negative for the Japanese yen. Now, before I get into why that is my view, I want to kind of focus your attention to what happened when we saw massive volatility. On dollar yen alone, we had 392 pips sell-off in 23 minutes. So it was a fairly illiquid market. It was an amazing move, and a lot of it was stop loss driven. So unfortunately for many traders and investors and exporters that were hedged, the market moved wildly overnight, and certainly here in Switzerland, we came in the morning kind of looking at our desks and looking at our charts, just wondering which levels to send out to our clients. But this was a big move. But one of the things I really want to, more than that, I want to focus your attention to is not just what happened to dollar yen, but did everyone kind of look at what happened to high beta, highly volatile or high yielding currencies? So I'm focusing here on popular carry trades. So if you can just see, just here on the axes here, I've got a chart of, it's an intraday chart, by the way. This is an hourly intraday chart during the sell-off we saw about a week ago, 16th of March. And here we have the currencies: dollar yen, Canada yen, Australia yen, New Zealand yen, Turkish yen, the Turkish lira, Russian ruble, South Africa yen, and Brazil yen. Now I've purposely chosen the last four currency pairs. I've purposely chosen high yielding currencies. So currencies which have high interest rates and offer high returns to people who are looking for carry trade. And of course, they will borrow from the Japanese yen, which is traditionally a low-yielding currency, and invest in high-yielding currencies, which tend to be in the emerging markets regions. So emerging markets, which are undergoing huge growth cycles at the moment, Turkey, South Africa, Brazil, and Russia to an extent, had massive sell-offs during the big move in dollar yen. And just to mention, the move in dollar yen was a new post-World War II record low. So we have not seen lows at this level, which was around $76.25. Now, so the key message behind it, this is what happened a week or so ago. You can see here, this is actually showing you what happened when the earthquake hit. There was a minor correction. All yen crosses moved sideways, and then we had a big sell-off. The bigger sell-off, of course, happened here on the 16th of March. You can see here dollar yen spikes about 3 standard deviations or more, but the high-yielding emerging market currencies, Turkey, Russia, South Africa, Brazil, they deviated up to 7 standard deviations, and that's what I say here. High beta carry trade, FX rates fall 7 standard deviations. This is the mean, and here's the deviation scale. Now, most importantly, after that, 5 days later, after the quake, the G7 nations intervene, and they pump trillions of dollars into the market, and basically show their solidarity with the Japanese people, and then we get a massive recovery, V-shaped recovery in the market. So this is what happened on the day. I want to just point out to you what happened on that day, just to remind you, but also to focus your attention, not just dollar yen reaching post-World War II lows at 76.25, but also the emerging market high-yielding currency trades. Now, someone's asking me, what about the gray horizontal bars? For those of you interested in trading techniques, I'm very keen on distribution charts. So we start off by looking at probability distribution. This is what I would call a market profile distribution. This basically highlights the price distribution. So this aggregates price moves and highlights key value areas. So this just shows you that 100 was a key area. You can see there's a spike in the histogram. Think of it as a distribution. Price spike here, price spike here, price spike here. But then this is then a shift in price value. As the market sells off here, you get a new value area. And this small move here is the fat tail. This is the extreme move when we see the big move down. Okay, I hope that answers your question, Mike. Okay, moving on to something a lot more current. This chart was updated as of basically dollar yen has moved slightly higher into the 82 area, since this chart was printed in the early morning hours. But the key thing here I want to focus your attention, it's quite a noisy chart. Quite a few people give me mixed feedback about how wild my charts are, but I try and kind of put as many words into the picture. And the key message here is this is a daily chart of dollar yen going back currently going back to October, and this is the infamous triangle pattern which a lot of people in the market will maybe swing trading. And of course, this is the triangle where dollar yen actually broke out sharply, 392 pips in 22 minutes into new post World War II record lows down at 76.25. Now, I also look at this triangle as an Elliott wave pattern. So, do many people in this chat look at Elliott wave analysis? Elliott wave analysis is just a way to look at cycles, fractal cycles in the market, and just understand how cycles and patterns exist in the market. So this is an important stage in dollar yen, in my opinion, because it highlights how there might be a signal into the final move down. So the major triangle pattern, what I classify as wave 4, which is just before wave 5, the primary impulsive wave in Elliott wave analysis. This major triangle breakdown signals a final move down, either the low at 76.25 or, in my opinion, maybe lower than that. I'll go into why. Thanks, guys. Have you ever thought about going into marketing? Awesome charts, was expected to see on sale now. Well, you know what? Thanks very much for the positive feedback. We have a fantastic marketing team here, and one of them is sitting right next to me, so I'm hoping they take notes about this positive feedback. Thank you very much. I try and take as much good feedback as possible, and I like to keep my charts informative and colorful. At times they're too informative and too colorful, so my apologies if it's a bit too noisy. But yeah, this is a daily chart. Everyone's laughing out loud. That's good. The marketing team, I think, is also laughing. You can probably hear them in the background. So anyway, going back to here, dollar yen daily chart triangle pattern, which is part of an Elliott wave structure, which is a kind of a cycle pattern analysis. Thank you very much, guys. I'm more than happy to come and speak at FX Street. It's an honor to be here. But I want to make sure that I give you this information before we get cut off. I want to make sure that we keep it Swiss timing for all our audience there. So dollar yen daily chart moving within the sideways range, this triangle range, which is part of an Elliott wave structure. Elliott wave is a way of looking at cycles and patterns that exist in the market. And this triangle pattern between ranging between, I think it's 80.22 and around 84.20, I think. This range highlights a breakdown which signals the final move down. Now, I want to make sure that we focus everyone's attention that when I say final move down, everyone in the market, I think, or most people in the market are thinking that this is the final low in dollar yen for some months. I want to make it clear that although we've seen a positive recovery in dollar yen today and maybe over the next few days and few weeks, I'm still thinking that we might see further correction over the short-term period. And I'll explain why in my next chart. The second thing I want to highlight, so the first thing was the triangle pattern breakdown, part of the Elliott wave structure. Someone asked the question, is this DeMark indicators I'm using? Yes, these are DeMark indicators I'm using. Some of you who are aware of DeMark indicators, that's another area that I specialize in, Tom DeMark indicators, which are proprietary indicators. The 9s and 13s are basically signal turning points in the market. That's all I will say about DeMark at the moment because it's quite a big area. Other than this daily chart, I want to focus on this chart here. Can everyone see this chart here? This blue chart. Someone saying they love Tom DeMark indicators. Very good. I've worked with Tom DeMark for several years when I was working at Bloomberg prior, and he'll be happy to hear that he has a fan base at FX Street. But basically, looking at this blue chart here, if I can focus everyone's attention to the blue chart, everyone looking at this chart here, try and ignore the triangle pattern breakout and the new World War II record lows, and just focus your attention to the small chart. What I'm trying to show you here is this is what happened in 1995. So this chart is 1995 during the Kobe earthquake. So of course there was another earthquake in Japan that took place in exactly the 18th of January 1995. And this is an interesting chart. So I, like most people, like to look at historical events just to gauge what can happen now. And here we see that the market was consolidating for 8 months before the actual breakout. Similarly to what happened a few weeks ago, we were making record lows. The record low back then was at 96.12. But interestingly, the earthquake took place at the 18th of January, and the market took about, not 30 days, I need to make adjustments to the chart, 40 days after the earthquake in 1995, the Kobe earthquake in 1995, the market broke out, made a directional breakout 40 days afterwards. So over 1 month later, dollar yen broke to the downside and it made an 18% decline. Now, again, I want to make sure to make clear, I'm not saying that dollar yen is going to move 18% lower, especially for disclaimer and legal reasons. I want to make sure that no one's reading this as any forecasting. These are just my educational ideas that I'm sharing out with you. But the other point is that I want to focus the attention that there was a massive delay in the breakout after the earthquake that happened in 1995 in Japan, Kobe. And so, interestingly, now the point I want to make here is that the breakout that we saw, the big breakout that we saw to new post-World War II record lows at 76.25 happened only 5 days after the earthquake. 5 days. So it was basically 3 or 4 weeks faster than what happened in 1995. So if we're comparing crisis events, what happened in 1995, the Kobe earthquake, and now, the positive observation is that the breakout that we saw now was much faster, and in my opinion, that might indicate that we will see an earlier or faster recovery, but it will be a volatile recovery. So the fact that we had a directional breakdown that happened earlier, over 4 weeks earlier than what happened in 1995 in Japan, Kobe, I think is a positive indication, but it will be a volatile reversal. Is everyone okay with that? I know I'm talking a bit quickly. I'm just looking at the time here. So all we're talking about is the triangle breakdown, which is part of an Elliott wave structure, signaling a final move down. But I'm also focusing your attention to the point that the breakout that we saw happened 5 days after the earthquake, which was much earlier than what happened in 1995. And if I just focus your attention to the earlier chart we're looking at, you can see here 5 days after the earthquake, 2 or 5 days after the earthquake, that's when we had the move. Okay, now where am I going with all of this? This is a long-term chart, so I'm just showing some classical tech analysis. This is dollar yen on a monthly time frame fractal between 95 and 2011. This is the recent earthquake that we had where it lows at 76.25, and this is the previous earthquake that we had, or Japan had, in 1995. And interestingly, the main point that I want to make here is that these big event shocks, these big crisis events history proves that these events tend to create major reversals. Whenever anything really bad happens in this world, or with any market, it tends to be very negative. There tends to be an extreme bearish sentiment out there, but then it tends to create big reversal points in the market. So, the tragic earthquake that happened in Japan and various other crisis events that maybe happen in the market, the 9/11 attacks in New York and the States, wars that take place around the world tend to do that. Now I'm just going to quickly speed on. Just notice the patterns that broke down and how they right now they've reached a pattern objective, which is also we have a big buy signal on monthly. Okay, this is the Elliott wave structure going back to 1975, and all of this is within my articles on FX Street and on the MIG website. So feel free to check either of those forums This is just basically saying that a new low could signal an end of long-term impulsive structure and potentially a major upside reversal. I shall move to the DeMark slide. I shall move away. Sorry about this, guys. I'm just speeding through the presentation. Okay, I'll probably save this for next time, but you can see all of this stuff in the article. But basically, questions on Bank of Japan intervention and the G7 intervention. I've taken the time interventions which have taken place in Japan on these blue areas, and just basically highlighting what happened.